Good afternoon, good morning, good evening, depending on where you're listening to me from today. We're glad to have you with us for this December USDA WASDE report webinar from StoneX. I'm Arlan Suderman, Chief Commodities Economist at StoneX. And, this is a little bit out of character for USDA. Usually the December reports are kind of what we'd call a snoozer, kind of boring. But USDA decided to put a little bit of fireworks in there, made some big adjustments to the corn balance sheet, and some smaller ones to soybeans. We'll talk about that as we get into it, and I'll give you my opinion on it. You can make an argument for the adjustments it made. It's just very unusual for it to do it in the December report. So let's take a look at it. Let's go ahead and get started here today. We've got a lot of slides to cover as we look at the changes that USDA did. And I'd also threw in some more economic slides in here because I think they have relevance, particularly going forward. With the election and the economy and several things that are happening in the economy. And I think that'll impact the commodity markets going forward. And so I wanted to lay that baseline. And I figured with a typical slow December report, we'd have plenty of time to talk about it. And then USDA kind of throws a wrench into things. So let's get started. Price is a function of supply and demand is modified by the flow of money. And so we'll get the consumer price index data come out tomorrow, producer price index data coming out then on Thursday. And it's interesting to note, if you look at the right-hand side there, we're seeing an uptick in both the headline inflation number as well as the core CPI number. And the expectations going into this week's inflation data is that we'll see a further upward adjustment, especially for the wholesale level, the PPI numbers that come out on Thursday, which could preclude more significant numbers coming out, increases for the CPI over the next couple of months. So that's something we're going to have to watch. That could dramatically impact what the Fed does. Now, the Federal Reserve meets next week, and the general expectation of the market is that they will cut another 25 basis points from their benchmark rate. I'm not convinced that they will. Now, maybe they will. They seem to have an agenda here of wanting to get down. If they do, I don't think it's wise right now in the economy with what's happening, with the jobs picture starting to look better. Now, if you break down the jobs data, and I think I got a slide or two in here on it, you can find some numbers to support your argument no matter which side you are on. Whether you can argue, well, they're not quality jobs. And that would be a fair argument that you could make. But the bottom line is, when you look at today's small business optimism index, I couldn't remember the name of it, that came out, it showed a huge surge in small business optimism in the month of November. And the chief economist of the NFIB stated in the report that it was largely tied to the election. Now, small businesses account for 44% of the U.S. economy, 55% of our employment. And there is an optimism among small businesses of wanting to hire now after the election. And the fear is that it'll be inflationary because of Trump tariffs, which I will talk more about. But these small businesses, one of the things they mentioned was an expectation now that Trump has won that we will remove some of those inflationary pressures, even with the tariffs. And I'll be talking more about that as we go. So let's move forward. I want to update you on this chart. I don't think I've shown you this for a while. And this kind of shows the parallel in inflation numbers, year-on-year changes, versus what we went through 40 to 50 years ago. And so if we were to follow the same cycle, the expectation would be that we would start ticking higher now, maybe have a bump, pull back, and then a much bigger increase. And I did see a statistic here not long ago that when you get inflation over 6%, over the last 50 to 60 years, it's always been followed by another second bounce of inflation. Now, not necessarily to the almost 15% levels that we saw in 1980 necessarily, but it does raise the risk that we could have more inflation coming. And I think that is something the Fed needs to be cognizant of. When we, the talk is inflation is getting down there closer to 2%. But as this graphic shows, and was certainly something that came out in I want to say, poll surveys at people who are voting, was inflation was a significant factor. Well, prices are up 22% on average from where they were 4 years ago. So while energy prices have come down, and that's certainly a factor in inflation, which I'm going to show you here in a little bit, a lot of other things went up a lot more than 22%. And that's what the consumers certainly have remembered and responded to. Now, I wanted to update you on this because the monetary base I'd been showing you was going contrary to monetary policy and was trending higher. That does seem to have now trending at least sideways, if not trending lower again, following the shrinking of the balance sheet. My fear is that the Fed's going to have to stop shrinking its balance sheet over the coming year. And if it does that, that may hold the monetary base up there. But one of the keys is going to be, if we're going to have tax cuts or even an extension of the 2017 tax cuts that are set to expire at the end of 2025, which is extending those as one of Trump's priorities. If we're going to do that, and if we're going to have deregulation, then we need to have a cut in fiscal stimulus, which is fiscal spending. Otherwise, it can be inflationary. So that's going to be one of the keys to watch. Now, layoffs remain very low. You see an uptick there on the far right, but overall, they remain pretty low. Overall, the job picture pretty healthy. One of the things that's been stimulating our economy is we've seen a tremendous increase in home values. And as home values go up, we see a lot of equity in those homes that people are tapping into for spending. And this shows that we're seeing an increase in home equity loan operational lines of credit. And so that's been one of the things, among other things, that's been kind of funding the continuation of this resilient economy. Now, one of the things we have to keep in mind here is the debt ceiling. The debt ceiling was suspended in June of 2023 until January 1 of 2025. So today is December 10th. So in another 3 weeks, the debt ceiling is locked in at whatever the debt is on that date. And beyond that date, then we have to do some creative accounting, shall we say, the Treasury Department does, to avoid defaulting on any of our obligations. You know, we're not about to default on obligations. There's plenty of things the Treasury Department can do, but the longer it goes, the more creative they have to get. And this Congress and this president, I've said in previous webinars over the last year that a lame duck Congress, a lame duck president perhaps will have to deal with the issue. I misstated there. We'll do some creative accounting. They're not going to deal with it. They have to deal with funding the government past December 20th, or we could have a government shutdown yet over Christmas. So that's still ahead of us. But the debt ceiling does have to be dealt with, and that's going to wait for the new Congress and the Trump administration to reach an agreement on. And so we're going to have some creative accounting going on beyond January 20th, it looks like at this point. Now, if you look here in the middle, I have it circled: Medicare, Medicaid, $1.8 trillion per year; Social Security, $1.5 trillion per year. And by the way, I've got a graphic in here to show you there's 73 million people, mostly voters, 73 million voters who collect Social Security. You think we're going to see Congress a bit too anxious to cut that? One of the reform ideas is perhaps to say, okay, we're going to raise the retirement age for everyone under 50. Medicare, Medicaid, well, you take that 73 million who will also be on Medicare for the most part, add another 9 million people or so on Medicaid who aren't on Social Security, and you get $1.8 trillion plus spending. Another one that's difficult to touch, 950 billion for defense. You could probably find some efficiencies there, but that's going to be a touchy issue for a Republican Congress and president to cut. Interest on the debt, 1.01, almost $1.011 trillion. Now you add those four line, obviously you can't cut paying interest on the debt. You have to service the debt. So you add those four line items together and that comes to over $5.3 trillion. Now look straight above, right in the center, circled there, U.S. federal tax revenue. I guess I can draw a line here. It'd be right here. U.S. federal tax revenue, $5.07 trillion. So we already have a deficit here, and we haven't even touched the remaining discretionary part of the budget, which is about another $1.75 trillion. And the Department of Government Efficiency says they want to cut 30% of the budget. Well, essentially, it means cutting the discretionary part of the budget. That's not likely to happen. But you can see the kind of battle that we're going to have and what we're going to face. And keep in mind, if you're involved in agriculture here in the United States, the Farm Bill has to be re-signed or redone. And the Farm Bill is going to have to be rewritten in this context of those major cuts. So keep that in mind as well as we go forward. But that's kind of the problems that we face as far as the federal deficit. Here I circled it. The discretionary part of the budget is roughly 30% of the budget. So if you're going to cut 30% of the budget, you basically have to cut all of discretionary unless you can find some type of efficiencies in the mandatory areas, which means Social Security, Medicare, Medicaid, etc. Here I showed 73 million people receiving Social Security. Okay, U.S. fiscal policy on an unsustainable path has long-term implications for the commodity markets. I said that the funding for the federal government runs out December 20th. Congress is working on a continuation bill that would keep it funded until the new Congress gets here and says, hey, it's your problem now. Battle over the fiscal debt cap is coming in January. I mentioned that already. Our sovereign debt credit rating could be downgraded without warning based on how this goes. In the past, these credit rating agencies have primarily made their warnings about the political, what's the word I'm looking for, inability to come to conclusion to solve the problem. Now, with one party controlling the House and the Senate, maybe you do get some done. You may or may not like what the solution is, but maybe you actually get a solution. So maybe we don't get a credit downgrade depending on what that solution is. Now, steepening of yield curve is a signal of coming issues. That's something that I think has been behind the recent increase in Treasury yields. We've seen an increase. In fact, this week alone, I think, what is it, $159 billion in debt certificates are being offered to auction, coming at a time when we're seeing a trend toward less demand for those Treasury, those debt certificates, because we have like foreign investors keeping their money at home for various reasons. The many retail customers saying, hey, the stock market's near record highs, maybe I should have my money there, with yields coming down, etc. So we could see this weakness develop kind of without warning if investors do become more aggressive in drawing their money elsewhere. And then we'll see what the DOGE does, the Department of Government Efficiency overall. The fiscal battle, and to put a little bit of perspective on this, France just ousted their government. Now, Macron is still president in France, but the government under him, I think it's a prime minister and that kind of operates the government. He's been thrown out on a no confidence vote because the parliament didn't like his plan to cut their deficit, which was at 6% of GDP, and his plan would have cut it to 5% deficit. And he was trying to push through reform of Social Security, as I understand it, without a vote. And so Parliament voted him out. And Parliament is voted for by the people. They're representing the people. So apparently they're responding to the people. For a little bit of comparison's sake, our deficit to GDP ratio is at 6.4%. It's even bigger. Now, it just typically is very hard for an elected government to be able to make these type of reforms. Now, I'll name one that is finding some success, albeit through a hard road, and that's Argentina. They finally had enough pain in their economy with inflation getting over 200% year on year that people said, okay, cut what you have to cut the social programs, etc. It's not been easy, but they are getting it done. They are moving in the right direction. So have we experienced enough pain yet in the United States to support the cuts that have come? It's one thing to elect a leader who says that he's going to make cuts. It's another thing to actually implement those. So we'll see how this plays out. But making some cuts in federal spending is going to be a key component of controlling inflation. In other words, you got to cut that fiscal stimulus if we're going to also be cutting tax rates, which stimulate the economy, and cutting regulation, which stimulates the economy. Okay, let's update you now on how our commodity tracker is doing versus the 5-year break-even inflation rate. You've seen these charts many times. And you'll see here we've had a little bit of a tick downward here of late. There we go, trying to do an arrow, a little tick downward, but an overall trend higher. So we'll see if that continues. If we look at the 2-year break-even inflation rate, which is a little bit more responsive, we're still trending higher. And if you look at that, that's quite a ways we've gone up. That's about what, 1.25 points in the inflation rate and expectation that we've gone up. So that's a pretty significant move, saying the market is anticipating higher inflation down the road. And I think that's one of the reasons we saw the funds this fall cover their shorts in the grain and oilseed markets. They started rebuilding them in the soybean market and wheat market because they just thought, the fundamentals are just so poor that they felt confident being short there. And I got more on that coming. But if this continues to trend higher, that could impact that. Now, if we look at it overall, a commodity tracker with 27 different commodities in it versus the CPI, you can see that we've had some divergence over the last year plus, maybe 15 months or so. But overall, still a strong correlation of 0.84. Anything above 0.70 is considered statistically significant. So inflation has continued to march lower, ticked higher here of late, and expected to continue to tick a little bit higher. But commodities have generally gone sideways to a little higher. That doesn't include the grain and oilseeds as a whole, which I'm going to show you here shortly. If we look at the grain and oilseeds, they have continued to go down the same as inflation has continued to go down. This correlation is still strong over the last 10 years at 0.88. If we look at livestock, this has been one of them, and this goes into the food component of inflation, that has continued to track sideways to higher. And that's been one of the lingering inflation problems that we have faced, and that's largely because of the tight protein supplies that we have. Now, since the election, we've seen a real bump in consumer confidence index. Now, if you break down the data, it depends if you're a Republican or Democrat, and that's normal in every election. So right now, the Republicans think, hey, this is good. Let's spend money. We're good. The Democrats think, oh, no, the world's coming to an end. Let's not spend money. But the net result has been higher consumer sentiment. And so they're spending more money. And I'm just looking recently at the cost of the wholesale cost for ribeye steaks up there at record high levels, are close to it. Very, very expensive. The consumer is paying it. So it says something about consumer spending. Energy subtracker, this like grains is very close to the overall. It's still a 10-year correlation of 0.88, a little divergence there at the end, a little bit more than grain and oil seeds. So this is something we're going to continue to watch. If you throw together the grains, oil seeds, and livestock, the funds have gone from their record net short position to a modest net short, long. Excuse me. But keep in mind that this is a combination of modest short, which I'm going to show you the significant short position, uh, of short positions in wheat, and Minneapolis is a record short position, not so in Kansas City and Chicago. A short position in soybeans, a modest short position in soybeans, a long position, a modest long position in corn, um, a, a, a notable long position in live cattle, and a record long position for managed money in lean hogs. That's countered with a record large producer short position, as the producers have been taking advantage of the strength in the lean hog market to hedge their crush margins, so to speak, going forward, their feeding margins. Okay, I mentioned the differences between the different sectors of the commodities. Look at this, grain and oil seeds, pretty poor performance over last year. This is a one-year performance. What's doing the best? Well, it's the softs like cocoa. Been doing the best. Precious metals are up there as well. Now, gold's off of its record highs, but overall it's done pretty well over the last year. Let's talk some more about the election implications. And this gets down, and I know there's a questions on this, and I'll go back to the questions at the end in case I didn't cover everything. First of all, recently Trump made a promise of putting 25% tariffs on everything coming from Canada and Mexico and 10% on China until the borders are closed to illegal immigration of drugs. Fentanyl is the main concern there coming across the border. I think this is going to get settled pretty quickly with Canada and with Mexico, not so much for China. I think China will take some time. Note that from the point that Trump posted this on Truth Social, which automatically also, as I understand, goes on Twitter or X, or formerly Twitter as well, it was a very short time before Justin Trudeau of Canada called up President Trump, said, let's talk, and they had a conversation. And then Trudeau made a trip down to Mar-a-Lago in Florida, and they had dinner together and they negotiated. That was the desired effect. That's how Trump operates. And we've had 4 years of Trump previous to the 4 years of Biden. And world leaders got to know what to expect out of Trump. And so they're going to respond to him differently than they did in Trump 1.0. And so this is one of the things Trudeau saw in his first term, that when Trump says he's going to do something, he'll do it. And so he right away said, I'm heading down to Florida. Let's talk about this. And I think this will be settled before January 20th. Mexico, we got quite a different President Sheinbaum, I believe is her name. She's pretty new. She was just elected into office. I think she's only been in office like a couple of months. And so she has to not look like she's bowing to Trump. And I understand that. And I think Trump understands that. So when you hear the rhetoric coming from her where she says, we're not going to do what he wants, watch what she does more than what she says. And I expect there, in fact, we've already seen some changes, but I expect this to be settled with Mexico before January 20th, if not before January 20th, pretty soon after. It's going to keep us nervous in the meantime, because we do a tremendous amount of trade, well, with both of these, but especially Mexico, where we're concerned about here. And so the implications for U.S. ag trade is significant. 40% of our pork exports go to Mexico. It's our largest buyer of U.S. corn. Soybeans, the number 2 buyer of soybeans. We could go on and on. So they're a huge customer. But I do expect it to be dealt with. President Sheinbaum's predecessor did meet the requirements that Trump laid out. So it can be done. He had a working relationship that he was able to work it out with the drug cartels. I trust that she does as well, but that's what's going to be required for it to happen. Now in China, it's going to take more work. Both sides are posturing. China posturing today some more, indicating that they're going to whatever stimulus is necessary to counter the tariffs. That's positioning, that's posturing. One of the theories is here, we did get a trade deal in Trump 1.0. It took a couple of years, but we did get it. In my opinion, President Xi Jinping is in a much weaker position to negotiate this time than he was during Trump 1.0. Their economy has a lot of problems and their debt problems are really racking up. I believe that Xi Jinping will stay true to his long-term goals, but he's playing the long game. Therefore, he probably would not mind, maybe that's not the right word. He would probably see it strategically advantageous to help his economy out to reach a trade deal to buy more ag commodities from the United States in exchange for an easing of the tariff threat on Chinese consumer goods coming to the United States for the 4 years and then go back to the original goals. I could see something like that. Will it happen? I don't know, but I do think that that's a possibility. One of the questions that's already been posed is how far can U.S. soybean exports fall if we go into a trade war? And I'm going to say in the next 6 months, near zero, very little. Why? Why do I say that? Because of currency exchange rates and the beginning of the harvest in January in Brazil, we are seeing soybeans being offered in Brazil, shipped to China for the month of January shipment, cheaper than U.S. soybeans. So that switch is already starting to take place simply because of economics. And if you go to February shipments, about 80% cheaper per bushel. And if you go to March, it's like $1 per bushel cheaper than U.S. soybeans. So that switch will already happen anyway before Trump enters office. That's part of the longer term, and I've got a slide on that later on to be able to show you that switch that's taking place, a couple of slides, in fact. Now, the key is going to be whether we get a deal to settle the dispute before next summer when they start booking supplies for next fall shipment after Brazil's soybeans have run out. When will Brazil's soybeans run out? That is the key that we don't know, because right now it looks like, with the weather being favorable, Brazil's crop may be 20 million metric tons larger than last year. That's between 700 and 730 million bushels above last year's crop. So those exports could go deep into our fall. And with them being cheaper than U.S. beans, that's what China is going to buy, regardless of geopolitical risk. And then they'll buy the rest of what they need from us, regardless of the price that they have to pay for them, unless they can get them from Argentina, which they also do. So I'll push Brazil and Argentina together. That has been the trend that's been happening for many years. And that is a trend that I anticipate will continue until or unless there is a trade agreement to get them to buy more from us at a more expensive price. Now, what about the biofuels? We haven't heard much support out of Trump, either in his first term in office or in the campaign, to support the biofuels. And that's critical to the U.S. domestic demand, especially for what we see in the way of soy oil demand as a feedstock for the green diesels and sustainable aviation fuel, et cetera. And I've got some slides on that. One of the theories, and we've been hearing from senators who have talked to the new EPA chief, support for biofuels. I've heard a couple of senators have made some strong positive statements there. That's encouraging, because he hasn't always been very supportive. The new EPA chief nominee hasn't always been supportive of liquid biofuels, but this time around, big oil is very bought into the liquid biofuels as well. Maybe that makes a difference. So when it comes to the 45Z guidelines, the Biden administration is trying to get those guidelines out before they leave office on January 20th. That doesn't mean anything. It won't be guidelines, it'll be guidance. And the Trump administration has the legal authority to totally change it. And so the fuel processors who produce the green diesels are going to be reluctant to change anything to produce anything, to lock in purchases of feedstocks when they don't know if they're locking in a profit or loss. So that leaves the value of the RINs to cover the loss of potential loss of subsidies. So we anticipate that we're going to see production of these diesels drop by about 60%. So that's a significant reduction in demand for soy oil. And that's one reason we've been seeing a big backup of soy oil at cheap prices. But the good news is with palm oil surging, Indonesia saying next year they're going to go from a 35% blend of biodiesel made from palm oil to a 40%, the year after to 45%, the year after that to 50%. That's raised the price of palm oil enough now that demand for soy oil has dramatically increased on the world market. And so that has helped. That doesn't solve the problem. And USDA did not address this in today's crop report. They did not cut crush to reflect this coming expectation of a big drop in crush. So that's a risk that's still ahead. And I understand why they didn't, because it hasn't happened yet. But that's something to watch. Black Sea, Red Sea, I think those geopolitical risks calm down. We're already seeing big moves in that direction. China, that geopolitical risk is still going to stay there, as I've already addressed. When you look at the U.S. trade imbalance of China, Mexico, and Canada, you see the numbers here. And for 2024, that's through the month of September data. If you look at, and this is what happened to the soybean market during Trump 1.0, and we're not going to spend much time on this slide. We don't have the time to do so, but you can follow the on-demand version when it comes out here in another day or so, and be able to pause then at this level and study this kind of how the various news headlines relative to the Trump administration 1.0 in China, how they correlated with moves in the soybean market. Keep in mind that during this time, what we show here, ASF, that means African swine fever, was making major headlines as well. Okay, weather. Here's what the sea surface temperatures look like. We're seeing some strengthening of La Nina here as these easterly trade winds are really gaining a little bit of momentum, shall we say. We've got westerly trade winds here stirring up. And so they're coming together, and that's creating an upwelling in the atmosphere, a rising motion here in what we call in the MGO terminology, right in phase 5. And when you get phase 5, we tend to get the weather pattern that we have in the United States. This La Nina is expected to hit its peak really in probably sometime in the January time period. We've got cool waters up here in the Gulf of Alaska, which at times have been making their way around here. But here of late, we've seen a weather pattern that has allowed them to warm up somewhat. But those have been our major drivers. November was wettest on record for much of the southern plains, really alleviating some drought concerns in that area, easing drought concerns in the Midwest, but leaving us with significant areas of drought. The Southeast saw its hottest November on record overall, as you see here in this slide. If you look at the top 40 centimeters, which is about 16 inches of soil, we still have a lot of dryness. And those of you in the Midwest who have seen the rains, a lot of you have said the tiles still aren't running, and this is why. The soils are just so dry, they've absorbed the moisture, and we need more moisture without the ground being frozen. And so this is something to watch as we go into next growing season, is how much are we able to renourish moisture into these areas. And I showed you this before, but I wanted to remind you of it. And this looks back at all the weak La Nina winters that we've had and what happened the following growing season in the way of temperature on the right and precipitation on the left for the May to August time period. So this is a composite map of all the years, and the years are listed there. And you can see that it basically left the next growing season hot and dry, according to these composite maps. Now, not every year was hot and dry. In fact, if you break it down, it was just 6 out of 10 years. 60% of the years were hot and dry, and some of them were so extreme that it gave us these color codings. But note that we also have in this list 2009. Well, 2009 was a pretty mild, wet year with some big yields. So just because I show this, the bottom line is not a guarantee that we're going to have a hot, dry summer next summer. We may have a bumper crop with ideal growing conditions. It just says the risks are above average. So I want to paint that picture that we do face some above average risks for next growing season, but we can't be assured of how it's going to play out yet until it gets closer. Now, shifting south of the equator, remember the record drought that we were talking about when we did our October webinar? And right after that, and I told you the rains are about to start, and they did start, and it's been raining ever since. In fact, if you look over here, since October 15th, we're still below normal. But look, we've had over 10 inches on average. Now, if you look at this area here, we've had we're getting up over 20 inches of rain in some of these areas, almost 25 inches of rain in that time period. So a lot of rain. Whereas down here, we're in the 2 to 4 inch range. So there are some dry pockets. I see we got some dry pockets over here on the western side of Center West as well. But overall, the crop looks good. I talked to our team in Brazil this morning, and the crop is really looking good. And they said if there's any concern right now for Brazil, it's that the rains will continue into the harvest period in January and February, creating some quality problems or slowing the harvest so they can't get it harvested and shipped to export terminals, and they can't turn around then and get the corn planted. So that's what we'll have to monitor going forward. That's the biggest risk there. If we look at Argentina, there are higher risks of dryness. The market's really not trading it because it's expecting such a big crop in Brazil. But if we do have more significant dryness in Argentina, that still can turn out to be a story. USDA did raise Argentina's soybean production estimate based on higher acreage this morning by 1 million metric tons. It didn't cut corn, and that surprised me a little bit because they did cut corn acreage by quite a bit. And so we do look for smaller corn production there as well, which is another supportive factor I've been talking about for the corn market longer term. Here's the numbers for Brazil and Argentina and Brazil, and I mentioned the Argentine soybean crop got increased by 1 million metric tons, and that's just a little bit below where I'm at. So overall, that's about all that changed. When we look at U.S. ending stocks, this is the big number. We did see wheat come down by 20 million metric tons, USDA increasing imports by 5 million metric tons and increasing exports by 25 million, I said metric tons, bushels, million bushels, I'm sorry, 25 million bushels. And so it's a net change of about 20 million bushels to the bottom line. Still quite adequate supplies, and I'll show you my balance sheet in a little bit. Soybeans, no change at all for soybeans on their balance sheet of any significance. Look at global stocks, it really comes down to this corn number. I mentioned the big change in U.S. stocks, that's about 5 million metric tons. We saw Brazil domestic use of corn go up by 2 million metric tons, a little bit of an increase in Ukraine for domestic use, some other little adjustments here and there, and all of a sudden you're at almost an 8 million metric ton cut in global corn stocks. More than I anticipated, certainly more than what the trade anticipated, and those cuts going forward. So this is going to be something to watch. But USDA did not raise its marketing year average cash corn price, which says that even though we're cutting stocks, they're still adequate. They did the same thing to their soybean balance sheet, if you recall, a couple of months ago, cutting their soybean ending stocks number, but not lowering their price. But now they came back and they lowered their soybean price, and I'll get to that here in a little bit. We've seen this big increase in corn export sales, which USDA utilized to justify. And in fact, if you look at it, it's probably you can make the argument the USDA is justified in making this big a cut. It's more than I did, because I'm a little bit more conservative. I want to see how many of these are front loaded, and this is why. Unknown destinations is the biggest reason. Mexico's up by, was I think about 40 some million bushels over a previous year. Unknown destination is where the big jump in sales are. Who is unknown destinations? And right away, there's a lot of speculation that it's China. I don't think so. It could be, but I don't think so. That doesn't seem to fit. And so I think what it is a lot of customers, resellers maybe, saying multi-year lows, let's buy it, we'll get rid of it. So that would end up being front loading. I don't think it's all front loading. That's why I had raised my target by about 75 million bushels, but USDA went 150 million bushels. Maybe USDA will end up being right. I don't know. I'm a little bit more cautious to see if it's front loading first before I get that aggressive. Now, if we look at export shipments to date, we're still exceeding marketing year average. We're still marketing year shipments, inspections, I should say, to date, still exceed USDA's newly revised target, the seasonal pace we need to be to hit USDA's newly revised target, by, what is it? I think it's 30 some million bushels. So we're still above that. We still have a strong pace here. And so from that standpoint, if these aren't front loaded, you can make the argument for even additional increases. But we'll have to see if they're front loaded or not. Argentina will have the next big supply available, and they'll start harvesting somewhere here in March, to start impacting our demand, depending on the size of their crop. Ethanol corn usage, USDA went up by 50 million bushels. Even at that, our year-to-date usage exceeds the seasonal pace needed to hit USDA's target by about 12 million bushels. Now you see this big dip here in the latest week available that coincides a year ago with a dip there, and that's Thanksgiving week, because USDA is taking its data from ethanol that is loaded onto rail cars and moved out. And so Thanksgiving Day, Thanksgiving holiday, it doesn't happen. So we should bounce back next week overall. So I don't think that's a big concern overall. One of the things I mentioned earlier is we've had a big increase in exports of ethanol, up about 400 million bushels on the year. So that's a pretty big percentage increase. And you can see Canada is our biggest customer here. So when you come back to the tariff issue, that's one of the things that's of concern here. But look at United Kingdom, India, that's a big factor overall. And so that's been a big positive for our ethanol industry. Managed money still holding that net long position in corn. We look at our corn balance sheet here, USDA increasing fuel for ethanol, corn for fuel ethanol by 50 million bushels. I'm at 5.475. I was up ahead of the report by 25. USDA went up 50 million. And USDA may end up being correct there. I'm just being a little bit more conservative. They went up 150 million on exports, and I was up 75 million. So you can see the differences there. I do have a little bit higher feed usage estimate, so that's why my ending stocks overall is higher. And I'm operating off of a higher yield, 0.6 of a bushel yield. So a bigger supply by about 50 million bushels there as well. And so that feeds into the next year, which still at 92.5 million acres. That's an increase of 1.8 million acres with a 30-year straight trend line yield of 183. And we put in our anticipated demand estimates, and we do grow stocks next year. And that is the case likely until or unless we see a problem with South America's production. And if we do, then that increases U.S. export demand even further and draws those stocks down. Now, if we don't increase acres, we stay at 90.7, then we tighten up supplies here, 11.1% stocks to use ratio. That's a little bit tighter than this year. Not necessarily enough to really sustain a rally long term, but it's something to keep an eye on. And you've pretty much removed the safety margin then if you have a weather problem. So keep your eyes on production in South America, particularly the winter corn crop. Let's move on here in the interest of time. We're running out of time. Soybean export shipments exceed the seasonal pace needed to hit USDA's target by about 88 million bushels. The question is, where do we go from here? We've been way above the seasonal pace to this point. Now do we dip down well below it with the big Brazil crop? Part of it depending on whether they have any weather problems with harvest. The second part being what those yields are, just how big are those yields once they do start to harvest, because they will be cheaper. So with export sales of soybeans being so strong, where is it? The assumption by so many people is that it's China. But look, China, it's not. This 2019 here is during the trade war, but I would argue even more significant, it's during African swine fever, which cut their hog herd by 2/3 based on our sources in China. So you can see China is behind previous years. So then you look at unknown destinations. Well, up a little bit from last year, not significantly. Some of this, I think, is last week we did see Sinograin, which is a state grain buying agency for China, that one of the things it does is it buys for China's reserves. And China does not allow Brazilian soybeans to go into reserves. And Argentina isn't going to have much in the way of exportable supplies before late March or April when they start harvesting a new crop. So they bought about 10 cargoes of soybeans here last week, according to our cash sources in China, for shipment in March and April, when Brazilian beans will be a lot cheaper. So it's probably going into the reserves as kind of an additional buffer against a possible trade war. So that's demand that we have coming here over the next several months that is probably meant to be a buffer against a possible trade war going forward. If we look at, I mentioned earlier how Brazil's producing more and more. Look here at how the rapid increase in production year on year versus the United States, that it's increasing at a slower pace. Argentina relatively flat overall in its production, but Brazil really ramping up production. And with their currency, they're always going to be cheaper. If they have them available to sell, they're going to be cheaper than US. And so therefore, China imports, we're seeing the Brazil portion of that market share up dramatically. US is really losing that market share to China, which would be the blue colors on this graphic. If you look at Brazil's soybean exports, the major portion of them going to China, again, would be the blue color on the charts. So my soybean balance sheet, if you look at USDA made no changes, so there's no reds here except for the price, which dropped. That's down about $4 per bushel over the last 2 years. So that's a significant financial hurt in farm country. Now, I highlighted on my balance sheet the crush number. This is something to watch. How much do we see crush back off in late December into the first quarter of next year based on the lack of 45Z guidelines? What happens to exports? I'm 40 million bushels above USDA. We could see that go higher or go lower. That could go either way significantly, and that's why I think USDA didn't make any adjustments in this report, wisely enough. It's going to hinge on the size of the Brazil crop and the timeliness of being able to get it harvested into export channels. So right now, that's what you can see where I have it, and I have ending stocks at 486 billion bushels. I decrease acres modestly coming year, and I maintain stocks above that 400 million bushel level, basically. Funds have modest net short positions, the managed money does. Again, you can come back to the on delay version of this report, and this shows you current renewable diesel plants, biodiesel plants in the United States and their production capacities. You can study that. If you look at the increase in production capacity here and demand for feedstocks. You see that on this chart. And of course, this is complements of University of Illinois Farm Doc. And then here is capacity of announced projects for 2027 and later that could still come online depending on policy changes that we may or may not see. When you look at used cooking oil, which basically yellow grease, in RIN generation showing how much has been consumed and produced, we are trending higher with used cooking oil demand. When you look at total annual feedstock consumption here, and again, this is not a full year for 2024. In fact, I think this data is only through September. It may have October, and I think it's just September. Soybean oil is the biggest component, but next in line is used cooking oil or yellow grease that we see right here. And you can see how it's been increasing in market share. Another way of looking at that, on the left here, we see a chart in the breakdown from 2020 through 2022. That's a 3-year span, and how soybean oil made up 50% of the feedstock for making these liquid biofuels, the green diesels primarily. Keep in mind that California wants to limit this to 20% for sunflower oil, canola oil, and soy oil. Notice that yellow grease or used cooking oil was here at 17%. On the right, we see the past 2 years combined, and you can see that used cooking oil has gone up to 20%. And I'd say if I looked at just 2024, it would be even higher. And soybean oil is losing market share, going from 50.3% to 36.4%. And that's been hurting demand for soy oil. You can see how used cooking oil imports have been trending higher in the monthly data. And on the yearly data, you can see that basically about 55% of it does come from China. Okay, looking briefly at wheat. USDA increased feed usage by 5 million metric tons, increased exports by 25 million. They're now above me by 5 million on feed usage of wheat, and exports are about 10 million above me. So my ending stocks estimates at 807 million. And for the coming year, I have acreage the same. We're going to be adjusting that before next month's report. I'm probably going to increase acreage for next year. This is a 30-year trend line yield here at 50.4 bushels per acre. But you can see until we can get these export numbers increased, we're going to have plenty of wheat where our ending stocks are going to be quite ample. Doesn't say we can't rally, because keep in mind that wheat futures in the United States correlate very poorly to actual U.S. supply and demand. They correlate better to Black Sea fundamentals. And so that's what to keep in mind overall is what happens to Black Sea. Right now, early private estimates for next year's Russian crop are 80 to 83 million metric tons, down from about 82 million metric tons this year, 83 million metric tons this past year. And so this past year, they had a lot of surplus wheat from the previous year to export. They won't have that going forward. So that further tightens up the world global balance sheet, which I have a chart on that. So hard red winter is the big problem here yet overall. And major exporter supplies as a percent of annual usage are getting pretty snug. So if you take Russia out of that equation, then suddenly that starts to focus the world on the rest of the supplies, which are primarily in the United States, because we're the world's storehouse overall for wheat. They've been getting decent rains, really near average since October the 1st in the Black Sea region for the most part, but there are some significant areas in here that went into dormancy and less than desirable condition that are still at risk unless they have a favorable winter and spring. We look at Chicago's short positions in here, pretty significant. We look at Kansas City, pretty significant short positions for managed money. Minneapolis, record short positions. So take home, U.S. is well stocked with the primary food-based commodities, but we've removed some of the safety net there in case we have weather problems in a major producing part of the world for corn. I think we're going to have a lot of volatility in the soy oil market, and possibly the soy meal market if we see crush drop off. Wheat market continues to wait for Russia to actually start curtailing exports. USDA lowered Russian exports by 1 million metric tons from 48 to 47 million metric tons. I think they probably need to go down to as low as 42 million metric tons yet. And some private estimates are as low as 40 million metric tons. Soybeans, they're simply bracing for that big South American crop and very concerned about the loss of demand that we might see as we come to the turn of the calendar year without the 45Z guidelines on subsidies for U.S. biofuels. Corn stocks are still ample, but they are rapidly declining. So that really puts the onus now on us to watch Brazil's winter crop, the timing of planting, and then the rainfall to develop that crop. I've mentioned the 45Z guidelines and how that all plays out. I do think a tariff on China will stop or slow the used cooking oil coming from China. But if we're not producing, does it really matter? That's going to be key. Reinflation is still a lingering concern in the background. It's not really, it was supportive of the grain oilseeds. I'm not really certain it is now, but it could become more of a factor going forward. Geopolitical risks are rapidly changing. Some of that's positive in the Black Sea and the Red Sea. Some of it's negative when you look at China. So with that, I'm going to conclude my comments. I'll put my contact information here. You can find my commentary at stonex.com. If you go to stonex.com, click on Market Intelligence, scroll down to the bottom, and you can find my commentary there. Or follow me on X. You can also direct message me there as well, formerly Twitter. Now let's go to the questions. Marco always has good questions. The USDA left unchanged the balance sheets of beans. We know there's a risk of a trade war too. How far exports fall. I've given that, answered that. If you have more questions at Marco, reach out to me and I'll be happy to discuss it more. If we join in this scenario of a trade war, weather that has been near perfection in South America and therefore a likely soybean crop in South America, how much more can beans fall? I can't, how we're set up under Dodd-Frank, can't give specific targets for derivatives, but I can say that that's going to leave us very vulnerable to falling lower, significantly lower. That's all I can say. Will restrictions on used cooking oil imports to the U.S. improve soy oil demand price? That is certainly a positive for it. The question is, what will production of the green diesels be doing? And that's going to be dependent on RIN prices and on getting 45Z guidelines out of the Trump administration, because anything comes out of the Biden administration won't give the confidence of the processors needed to increase production. I got to know what the Trump administration is going to do. And so until we know that, I don't think it helps significantly. Next question, don't you think USDA had a very strong hand in raising the export line of corn? Yeah, for the month of December, I think they overplayed it, but we'll see. You can make the argument that they're right. I just think it's a little bit early. Stocks to use ratio in soybeans in China is 36.3% versus 17.5% in 2016. Why China is a weaker position? Oh, and that's a good question. It means I didn't clarify. They're in a weaker position regarding their economy. And their biggest concern right now is the potential additional tariffs on consumer goods coming to the United States. And their economy is hurting. So that means that they're in a bigger position of really needing to negotiate, to get Trump to back off of those. USDA's corn and soybean export demand estimates realistic. Are exports being front loaded? I think ahead of the inauguration of potential tariffs. I don't necessarily think it's a tariff. So we saw the same thing in 2020. If you remember, we had a lot of unknown destination sales of corn that year as well. And I think the same is true in soybeans. It's because we were at multi-year lows at harvest time there as well. That's when basis is the weakest. That's when futures are the weakest. So that's when it makes sense to front load your demand and to buy. In a trade war scenario, does the U.S. have sufficient crush capacity to offset losses in exports in a meaningful way? Not to totally offset it, no. Fortunately, I believe there will be a trade agreement before next summer when it would matter because China would be starting to buy for next fall's crop. But there's no confidence in, no guarantees of that. Given the strained farmer margins, are we likely to see acreage in Brazil increase back in line with historical trends? We are seeing a slowdown in the expansion. But I heard a lot of people say 3 months ago, can we get a post-harvest bounce? And I said, as much as you'd like the higher prices, you don't want it now. You don't want that bounce to come until after they've made their decisions on planted area for their winter crop. And they'll be finalizing those decisions over the next 30 days. Do you see any further upside for coffee? Boy, that's one I didn't. We do have a really good coffee network that puts out a newsletter at StoneX, and I didn't check with it before coming on here because I wasn't expecting a coffee question. Good question. I'm sorry, I just don't have an answer for you. Eric asks, if biodiesel producers are reluctant to produce based on 45Z uncertainty, how does the RVO get filled? Will RINs move more sharply higher? Yeah, it's RINs that are going to have to do that. The problem with the green diesels is the RVOs aren't high enough. And that's been a problem since they were first announced. But RINs are going to have to do the work in the meantime to get the RVOs filled. Let's see here. CFPC is encouraging feedstock other than, California, encouraging soybean oil to be used for biofuels. And this is one of the big problems is we see California and we expect other states to follow in limiting because they're trying to push people toward electric vehicles. They state that as their objective. And so do I think USDA soybean oil demand estimates for biofuels are too high? Yeah, primarily because of the lack of any guidelines that's going to dramatically reduce production. Feed residuals of corn shouldn't be reduced given the total supply is lower than what was expected 2 or 3 months ago. That's one thing we'll find out more about when we get the quarterly stocks report for December and the final January numbers going forward. Peter asked, China to the U.S. is questionable on, given used cooking oil from China to the U.S. is questionable on future imports to the U.S. based on potential investigations likely to show not actually used cooking oil. Will this impact palm oil imports to China that have possibly been re-exported to the U.S.? We're already seeing that. With palm oil prices jumping, we anticipate that China is going to have to import about 200,000 metric tons per month of soy oil or increase their own crush to meet that demand as Indonesia keeps more of their palm oil at home. So that's already something that we anticipate. And that's what the market's been pricing in here of late. Will restrictions on used cooking oil imports U.S. improve soy oil demand and pricing? Yeah, we're starting to see some of that. The problem is the reduced production once again. Are we still on the sell bean buy corn mode following this USDA report? Obviously, I can't, the way my department is structured, give recommendations on that, but the bias of the market has been favoring corn over soybeans. In fact, if you look at average if you look at national average cash corn price, it's up over 50 cents per bushel over the last 2 months. Whereas when I looked earlier, soybean price is up about 35 cents. If you look at the new crop soybean corn price ratio, it's trading at about 2.29 right now. I've seen that trade as low as about 1.83, I believe it was. That's many years ago. So that's possible. I'm not forecasting that by any means. I'm just saying there is room for that to move. Wheat and corn can work together in tandem to separate themselves from soybeans somewhat. If wheat acreage increases, will those acres come from what crops? Um, Milo in the plains, cotton. Um, it can come from soybeans in the plains and in the south. You don't get away from your rotations too much in the core of the Midwest. Most of the acreage shifts come in the plains and in the south. And that completes our questions for the day. We went a little over time. I apologize for that. But I do look forward to, I believe January 10th is when we come back. That's the biggest crop report of the year. So much to talk about, so much data, so many potential surprises in that, as well as updates on South American weather and looking ahead to the growing season coming here in the Midwest. Thank you for being here today. And I hope you all have a happy holiday season and a happy new year. And we'll be back with you in January.